Hi there, welcome to Nepi Invest. When I first started investing well over 10 years ago, so we're talking about 2010, 2011, I was following quite a few companies because I thought they had pretty good potential. And then for various reasons, I stopped following those companies. And then I've decided just to look back to see how those companies are performing right now, if they still exist. And in today's video, I'm doing exactly that, looking at a company called Antio Tech, T code ADO. I started following this company about 2011 because I liked their products. I liked their potential. They had a product called Mix and Go. They were into or trying to get into point of care diagnostics. And just after I stopped following this company, they started to talk about lithium batteries. So in today's video, I'm going to go through their March quarter results just to see if I've missed the boat. At one point in time, it looked like maybe I had, because the market cap of this company was something like $200 to $300 million. Now that market cap has significantly fallen. In fact, I think the market cap might have gone as high as $500 million at one point in time. So let's talk about this company and talk about what they actually do. This particular slide comes straight from Antio Tech's website, talking about their objectives and talking about how they're going to get growth in the future. So their objective is to grow their company by leveraging their globally patented service management technology in markets that are facing significant development challenges. And then they start talking about point of care diagnostic testing and lithium ion battery markets. So no mention of Mix and Go. So when I was following this company, I was interested in Mix and Go. And Mix and Go is a ready-to-use activation reagent specifically developed for binding biomolecules onto planar surfaces. Now, it doesn't look like this particular product has been successful based off the cash flow in the last quarter report, which we'll talk about in a second. Now, to achieve growth, Antio Tech will, so they're being pretty certain there that they will continue to enhance their service management technologies for use across a range of industrial scenarios, enhance their research and development processes to achieve certification with recognized industry standards, blah, 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 invest in patent and IP to enable leverage across key markets. So I think the big question here is they haven't really done anything over the past 10 years. So my main question to Antio Tech is, when are you going to get this growth? And I think the market is a little bit wary about this company right now. And you can definitely see that wariness when we look at the chart and what the share price has done over the past few years. Antio Tech was founded in 1995. However, I'm a little bit dubious about that date. But if you do actually Google when was Antio Tech founded, it comes back as 1995. That's the last thing I did, because there's a little bit lacking of information out there in regards to the history of Antio Tech. Now, when it comes to their listing on the ASX, a little bit complicated here, because in April 2000, there was another company called SSH Medical that listed on the ASX. And then whatever they were trying to do was not successful. And then they relisted in 2005 as BioLayer. And then eventually BioLayer became Antio Tech. I'm not sure if they bought out Antio Tech or if this was a reverse merger. I didn't do that much research. Current CEO is David Radford. He has 0.03% holding in this company. And the market cap of Antio Tech is $72 million. That's at a share price of 3.5 cents, significantly down than it was about 2 years ago. Shares on issue, just over $2 billion. Now, back in January 2008, shares on issue, 148 million. So that means there has been more than a tenfold increase in shares on issue over the past 15 years. And the main reason behind that is because this company is burning through a lot of cash, and they really haven't found any sort of product they can sell that has turned them into an operating cash flow and free cash flow business. And the ticker code for this company is ADO. Now to the company's Appendix 4C for the March quarter. And there is a reason why I haven't been following this company over the past about 7 or 8 years. And that is because this company isn't really producing any cash flow in their operations or their business. In fact, in this particular March quarter, they only had $62,000 of receipts, and for the first 9 months, only $480,000. So this company is burning through a lot of cash. In fact, in this quarter, they burned through $2.5 million of cash in operations And for the first 9 months, $5.4 million, even though they have received $3.2 million in government grants and tax incentives. They're also receiving options. So the exercise of options, they did get $1.8 million. So shares on issue are increasing because of the exercise of options. And at the end of the March quarter, $5.5 million of cash. So if they don't improve their business, they're going to have to do another capital raising, probably within the next year. Now to the receipts history for the company, and you'll notice in 2016 and 17, they had an absolute explosion in receipts. And there was a reason behind that. They actually acquired a business that actually was selling products. So they thought maybe, I'm not quite sure, because this was sort of around the time or just after I stopped following their company. But they probably thought this was a wise acquisition, get a bit of cash flow into the company, and that cash flow could support the rest of the business or the company. And that acquisition only lasted 7 quarters, because then they sold that company in late 2017, early 2018. And after that, you can just see cash receipts have been absolutely abysmal. And in this particular slide, we're looking at issuance of common stock or capital raisings plus free cash flow. And this is the ultimate problem for this company. They are burning through a lot of cash. And because they are burning through a lot of cash, they have to do continually do capital raisings. In fact, almost every single year, they've done a significant capital, maybe not significant capital raising, but a capital raising. The biggest capital raising was in 2021. They raised $24.2 million. And I think that might have coincided when the share price was fairly high, which is probably a fairly wise capital raising. They also did a significant capital raising in 2016, $9.7 million. That could have been because of the acquisition. Another significant capital raising in 2014, $7 million capital raising. And every single year, they are burning through a lot of cash. In fact, the most recent year, their free cash flow was negative $11.8 million. By far, the worst burn cash this company has seen in a single financial year. Because we are in different times right now, and the market is more concerned about profitability and cash flow than just growth of the business, companies like AnteoTech have to cut costs. And the management of AnteoTech is obviously thinking about this, because in their quarterly report, they mentioned that the company is undergoing multiple initiatives to reduce the cash expenditure, including ceasing of clinical studies on COVID products. That seems like a pretty good step. Reducing headcount or firing staff, reallocating headcount to growth areas of the business. The question is, what would be considered a growth area? Because they only had $64,000 of cash receipts in the last quarter. And focusing expenditure on key strategic growth initiatives. And again, growth initiatives, what is going to be that growth for this company? Because only $64,000 of receipts in the last quarter. Now, these initiatives have enabled cost savings of $400,000 per quarter. Now, based off the cash burn in the last quarter, based off the cash burn in the first 9 months, they're going to have to do a lot more than save $400,000 in costs. And the best way this company can become profitable and cash flow positive is not by cutting costs. It's by growing their cash receipts, by growing their revenue. And that is the main question I have for this company right now. Where is that growth going to come from? In this particular slide from Guru Focus, we're focusing on shares outstanding, which is the purple top line going from the bottom left to the top right. And in fact, there's a sort of rise you don't want to see in shares outstanding or shares on issue. You do want to see that sort of rise when you talk about the share price. Whenever you're looking at a chart, you want to see the share price going from the bottom left to the top right. But when the shares outstanding is going from the bottom left to the top right, that's telling you the company is continually needing to raise capital, which is understandable for this company because they have not had any success in selling their products. Again, cash receipts in the March quarter, $64,000. So to fund their business, to fund research and development of their products, they have to continually raise capital or cash. Hence, you get shares outstanding increasing tenfold, in fact, more than tenfold over the past 15 years. Now, when it comes to the market cap, an interesting story here. There's been 2 periods of time where there has been a fair bit of hype in this company. The first period was, or the first year was 2014. I still remember that because I was questioning, why was the market getting excited about this company? There was actually no real reason behind it. It was just a short period of time where the market got really excited, and that excitement pushed the market cap of this company to 300, I thought it was 300, yeah, about $300 million. And then that hype died away because this company, again, not generating cash flow, is not profitable, and the market fell all the way down to about $10 million. And then there was a regeneration in that excitement after COVID-19. And I still remember, why was there is excitement in this company again? And that excitement pushed the market cap of this company to $600 million. I still don't understand why the market got excited about this company back then, because again, this company is not generating any cash flow or any significant cash flow in their business. So again, I think the market just got way ahead of itself, got a little bit too excited. And this is a sort of really important lesson to don't get caught up in that excitement for companies that are not profitable, for companies that are not generating any cash flow in their business. And now the market cap has fallen from $600 million all the way down to about 70 million. So almost 90% decrease in the share price in a fairly short period of time. And finally, the long-term chart for AnteoTech going all the way back to 2012. So I started following this company a little bit before then, and then we had that little bit of excitement period in 2014. Share price actually went from about 6 cents all the way up to a high of 26 cents. I actually do remember that. It wasn't over a very long period of time, and then you just see a share price pull back. So sort of the Matterhorn pattern, which we are seeing in a lot of tech companies right now, a rapid rise in share price and then the share price falling. And the share price kept on falling for about 5 or 6 years. So the peak in the share price was in 2014, early 2014, and then the bottom was probably 2019 or 20. And then we saw a revigoration in that hype in late 2020 when the market got really excited about this company. Share price actually went from about 2 cents, maybe even less than 2 cents, to a high of 50 cents, a 25 bagger in a fairly short period of time. But then because this company is not profitable, I've probably said this a few times already in the video, because the company is not profitable, not generating any cash flow, that excitement eventually withered and died away, and the share price has fallen from that high of 50 cents back down to, what is it now? 3.5 cents. So we're getting back towards those lows we saw in 2018 to 2020. That's all I have for this video on AnteoTech. If you are a believer in this company, I'd love to hear from you. So can you leave some sort of comment about why you think this company will be successful in the long run? And there is potential, because when I was following this company, they were talking about their point of care diagnostic testing. They were talking about their lithium ion batteries. So there is that possibility that this company is on the cusp of finding something successful that they can sell to customers that could finally bring in some cash flow to the company. But until that point in time, I'm staying out because the share price is in a downtrend. Share price has gone from, what was it, 50 cents all the way back down to 3.5 cents. So if you do have any positive thoughts about this company, I'd love to hear any positiveness about AnteoTech. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.